Good afternoon, folks. This is Ed Walsh with ASCSP. This is our fourth of our virtual learning summit sessions, and we're very pleased to bring you two folks that we've had with us many times before, doing us a favor and giving us another session today. Kristen Wood and Tracey Watkins. Let me go through my little requirement here before we get started. You're going to see polling questions. Please make sure you answer them, particularly if you're looking for CPE credits. You'll be muted during this session, so please ask your questions using the questions function, and we'll fit the questions in as we can throughout the presentation or near a polling question or something like that. The slide deck and the recording will be available. And of course, if you're asking for CPE, please send me an email. Just let me know that you are. So without further ado, I'm going to switch the screen over to Christian.
All right, so switch. So do I need to have the slide deck up, or can I pull it from?
Yeah, I see it. I see something here, but that might just be your home page. There should have been a box that popped up that said, "Do you want to share your screen?"
I got that part, but I didn't realize I had the slide deck up then. Sorry, folks, for the technical difficulties.
No worries.
I was trying to. Well.
Trisha, do you have them handy, or should I can try to send them to you? All right, you got it.
Pull them up from the download, yeah. Can you see the PowerPoint opening up?
Yes, sir. There you are.
Yay. All right. It's been a while since I've done this. Where's my start presentation?
Slideshow. So there you go. And then from current slide.
Beginning.
Over, yeah.
All right, you can see it all without seeing the next slide?
Yeah.
We're good? All right.
That looks
Sorry
great.
about that, everybody. I was going to say, it's been nice to be back. I think I've been involved or presenting for like the last decade or so, so I'm starting to think I'm getting old. But I'm always happy to be here. It was funny when we sort of were proposed this for like an hour on legislative updates. I'm not sure we're going to have a whole lot to talk about, and there's stuff that was changing even this morning, so there's plenty to talk about. Let me start off by introducing myself. My name is Christian Wood. I'm at RSM. I head up the Credits, Incentive, and Methods, which sort of is accounting methods, R&D, tangible property services, which is your cost seg, so forth. So I sort of get, as I like to think, I get what no other group wants. And I'm within the Washington National Tax. And with me today is Tracey, and I will let her introduce herself.
Thanks, Christian. So my name is Tracey Watkins. I'm a senior director with RSM. I am within the accounting methods group. I'm also the technical lead for the tangible property services group. So I get a lot of questions on cost segregation issues, but I also have to follow policy as well, because that does impact our work in the tangible property space. So Christian, I'll hand it back over to you.
Thank you. And so we're going to start today with the Inflation Reduction Act of 2022. Up until, I think it was like 8 days ago, this was introduced. Up until that point, everybody, for the most part, there were a few exceptions, but for the most part, everybody thought that it was dead when Manchin said he just couldn't get along with it. And so we figured that a lot of this was going to sort of end up at the potential end of the year, extend some of it. But again, we were all pleasantly surprised, or at least it keeps my group busy, so we were sort of happy with it. In part of the budget reconciliation agreement, the goal of it is twofold. Well, one is to sort of fund the climate and energy incentives, help with the affordable health care costs. And then also a big chunk of it is to actually reduce deficit reduction. So, how many times have we passed bills recently, and by we, I mean Congress passed bills recently that actually reduces the deficit and doesn't increase the deficit. So that's kind of big picture, right? So, and the point of this, right, they call it the Inflation Reduction Act, is it reduces future deficits, in essence removes cash from the environment so that prices either go up slower or hopefully don't go up at all. And so that's about half the function of this. It's also, there's some healthcare that we're expiring, so this is to sort of continue on some of the subsidies. And then one of the big things that's sort of been in the news over the last several years is whether or not the federal government can negotiate lower prices like companies. That's been sort of going back and forth, but that is actually in here, and hopefully that will reduce the healthcare costs and make things more affordable, lower healthcare costs, lower rate of inflation. And then again, a lot of the energy security and climate change solutions are part of this. And so you can see sort of the makeup of it, 369 for the energy and climate change incentives, 64 billion has to do with the Affordable Health Care Act, and then $306 billion is for future deficit reduction. So that's an overview of sort of broad strokes of what it covers. So the agreement raises about $739 billion over the next 10 years. And so it does this through primarily a couple of things. One, there's a minimum book tax. So if you have like your Amazons, very large corporations that for tax purposes have no income or don't pay any taxes, this would establish that you have to pay a minimum of 15% tax based on your book numbers. And so even if you were successful enough in all the right tax incentives to get down to zero, you still have to have some skin in the game, 15%. And so one of the things that kind of highlights this is not that we have a lot of clients in this, since I think it was estimated to hit about 200 total taxpayers, right? And this sort of also will come into effect a little bit when we get further, down the road when we have a Pillar 1 and Pillar 2. This has to do with your international. And Pillar 2 is there has to be like a minimum tax rate in your taxing jurisdiction. Otherwise, a second jurisdiction can tax you. And so one of the things that, accounting methods, cost segs, et cetera, can do is it can be used to control how much taxable income you have in any one particular year, right? So you can take bonus depreciation, you can elect out of bonus depreciation and take over a longer period. This kind of allows you to sort of model stuff out and get to the right amount of taxes that you want to pay. If you're in a situation where your tax rate is going to be lower than the minimum required, does it make sense to take an additional deduction, or does it make sense to, well, okay, in the long run, maybe I need to pick up a little more taxable income now, and that prevents me from, picking up a lot more taxable income in the future. So some of the stuff we're going to focus on sort of does that, allows us to sort of pick and choose what we want to do. And so that's kind of part of the reason why we bring it up. The second thing that is in the news a lot is the carried interest modification. There's more than just a change from a 3-year hold for capital gains to a 5-year hold. There's also restrictions on when that period begins. It used to be when you bought a partnership interest. Under these new proposals, it's not only when you bought the partnership, but has the partnership acquired all the assets that they're going to. So a simple holding period may not tell you the true story if this part goes into effect. Enhanced IRS enforcement, estimated to raise about $124 billion. That's really $80 billion in additional funds to the IRS, which should net $124 billion. So $80 billion in funds to the IRS should bring back $204 billion of additional revenues raised through the tax code. So it nets 124. With that much money going in, some of it's going to be monetization, some of it's going to be hiring staff. The more IRS staff they have, the more examination they're going to go through, the more things are likely to sort of be challenged on exam. And then the other big chunk is the savings from the prescription drug pricing measure, which is estimated to about $288 billion in savings. And then there's the clean energy incentives that we'll tackle in a moment.
Okay, thanks, Christian. So I think what was surprising is what's not in this bill. This is an incredibly detailed slide, but I'm just going to touch on a couple of things that we've been paying close attention to and that might be of interest to you. So at the top of the first bullet, we list out, there's no increase in the corporate rate. We were thinking there could be proposals from 21% to 28%, but you're not seeing that. I suppose that did kind of go away. It's one of the versions of Build Back Better, so it's not too much of a surprise, but it is something that I know the administration was pushing for. On the second bullet point, you're not seeing an increase in the top marginal income tax rates for high earners, going from 37% to 39.6%. We're also not seeing an expansion of the net investment income tax for certain high income taxpayers. We're not seeing an increase in the top capital gains tax. We're also not seeing a rollback of those 1031 provisions. So those are a couple things. One of the things that I think a lot of people on this call might be particularly interested in is that, and you might have been hoping to see a change back to an EBITDA-like base for Section 163J, because without that EBITDA, so the EBIT, your 163J limitation might kick you out of being able to take your interest deduction. And so what's happening is we're having a lot of taxpayers that are saying, well, I'm subject to these interest deductions. I'm not going to do a cost segregation study because I would just be trading one deduction for and not get another deduction. So some taxpayers are kind of saying, well, it doesn't make sense to implement a cost segregation study that I've done because of this 163J limitation. Now, you might see some taxpayers reconsider if they qualify to be an electing real property trader business. They might reconsider that election because of the change in the rules. But we're not seeing a rollback to the rules that we've been applying the last few years. So that's just something to watch out for, but it is not in this bill. We were really hoping for it. Also, Section 174. Many taxpayers were hoping for immediate expensing of R&D expenditures, and we're not seeing that in this bill. So let's go to the next slide for a polling question. And I'll briefly cover the polling question, but then I think that Christian is going to elaborate on some of the items that I just covered. So polling question, have you seen an increase in questions in this area? It's a broad question. You can just relate it to the Inflation Reduction Act. Yes. No, not yet, not sure. So we'll give you a little bit of a minute to answer that. And then Christian, do you want to talk a little bit more about some of the provisions that I mentioned on the last slide?
Sure. So what we do is great for our client, right? We do a lot of things. We sort of reduce current net taxes paid. We free up cash flow. If our client needs more cash flow, this is a way to generate it by deferring taxes paid. We reduce our current taxes paid. If we're in high inflationary, which I don't know about you, but it's been a while since I've seen 9%, all right, we may not necessarily need the cash, but if we can pay $100 less than taxes, put it into a savings account and get 8% return on that, and then pay that $100 back, we come out ahead. So there's lots of things we can do, but things now have gotten a lot more complicated. It's not just, all right, let's the lower tax paid. That's what we sort of focus on. Now it's more, all right, we're going to lower our taxable income, that's lower taxes paid, but in lowering our taxable income, are we going to run into 163J limitations? Are we going to take a $1 deduction and now make it worth 80 cents because of these other limitations? And so since the Tax Cuts and Jobs Act, we've gotten into more of we have to sort of model things out. And we have a lot of tools that are sort of under our belt to help us get to the number we need to get to. And so it's a bit more complicated. The discussions are a little bit more nuanced, right? Because it can't be like, hey, I can lower your taxes by X. Well, actually, we got to think about these other implications. And so we're starting to follow some of these other things like the 163J limitation. And then also, the reason I'm sort of focused on 174 is it's sort of a big driver. 174 was put into the Tax Cuts and Jobs Act to go from current expensing, or at least the option to currently expense, to a required recovery from 5 to 15 years, was to get to a budget number that the Republicans needed to pass the Tax Cuts and Jobs Act. no one actually thought it would go into effect. And so we fully expect that as part, well, it's not going to be part of this. We fully expected it to be addressed. A lot of Democrats agree that, yes, in fact, we shouldn't have to, how do we spur innovation if we're going to make it more or less taxpayer favorable, right? So we're going to spread out the cost. But at the same time, while Republicans and Democrats agree that that's a good goal, the Democrats see that as sort of the Republicans' decision as part of the Tax Cuts and Jobs Act. And okay, it's also going to be hard for me as a Democrat to go sell to my constituents that, hey, look, I'm giving deductions to corporations. That's a lot who does sort of the R&D stuff, but I'm not giving tax breaks to individuals. And so that's kind of stymied some of the negotiation under 174. And that's also part of the reason why it was, and why we thought it could be part of the original Build Back Better, was a strong incentive for the Republicans to at least agree to somewhat. But now that we've gotten the Build Back Better and 174 isn't, it's going to get punted to the extenders. And we'll sort of talk about the extenders in a moment. Hopefully, everybody answered the polling question so that they can get their DPE, and we'll move on.
Oh, I already closed it out. I'm sorry, I closed it out already. See if I can pull it back up. Can you see the results?
I'm trying to 20.
Yeah, not yet, but expecting to see more questions was the number one at 64%.
Right. And hopefully after this presentation, you'll be able to talk to clients through some of the concerns and issues. So thank you. We'll move on to the next slide. All right, so in order to, it's got a ways to go before it's passed into law. And it's changing on a daily basis.
Kristen, we're not seeing your screen. Yep. We're not seeing your screen.
Okay. Did I unshare it?
I don't know. I don't think so.
Do we need to close the polling question?
It did close it. Yeah.
It did.
It's
okay,
not
still showing.
Yeah. Okay. Maybe it doesn't like going backwards.
Practical problems.
Yeah. I've got, I hit the hide button, so everything should be off. Did you reduce your screen?
I did not change my screen except for look at the control panel.
All right.
So I make someone else the attendee and then back to me, if that works.
Yeah, I'm gonna change presenter and see if that helps. I'm gonna change it back to me for a second and then back to you.
All right, you should have it now.
There you go. Okay.
Right, we're back to the Inflation Reduction Act of 2022, clean energy incentives.
Yes, sir.
Okay. All right. So can we go back one? Yeah, let's do 45L. Or do you want to talk about obstacles first?
Yeah. And so some of the obstacles, right, it got introduced 8 days ago. A lot of activities happen in the interim. It has, in order for it to pass, it needs full support by every Democrat in the Senate and the Vice President because they're the 5 vote. Right now, it seems as though we have at least 49. We're still waiting on Sinema, who had sort of led to tanking of the Build Back Better, her and Manchin. So Manchin's now on board. Now all eyes are waiting to see if Sinema is also going to be on board. And as of this morning, 2 things it seems as though she's going to be concerned with are the carried interest piece and whether or not the minimum corporate tax of the 15% is drafted in the most appropriate way. So we'll start with the second one first, whether or not the minimum tax is drafted in an appropriate way. What that signals to a lot of people is that she's open to it, just wants to make sure that it's not overly broad. And so that's good because if you remember, that was a big chunk of the revenues raised. Now, the holding period for the carried interest piece, she has been on record as opposed to it. Manchin also said that he really, it needs to be part of this deal. So it sort of picks up this tension. But the carried interest portion only raises about $14 billion in the act. So if they decided to compromise and get rid of the carried interest piece, it would only cost the bill $14 billion. And so instead of $306 billion of deficit reduction, it would be $292 billion of deficit reduction. So it does not seem unsurmountable at this point. Right now, the House, I believe, is on recess. And so if the Democrats can pass it in the Senate, then, there's this thought that the longer it stays out there, the harder it is going to be to pass. So the House may get called back, and you'll need just about every vote in the House because that Democrats do not have that much of a margin. And so that is a concern that then makes, and the thought process is that most, if not all Democrats in the House will probably vote for it just so they have something to campaign on this fall. And so we would think that in order for this to be, if all the stars align, everything's perfect, which it won't be, but if everything was perfect, you could see this signed into law as early as August 10th, or it could take forever. Again, the longer it takes, the less likely it is going to be to pass. So right now, it's already been through the JCT, and there were no surprises, and the provisions acted like they thought they would, for the most part. And so now it's currently going through the Senate parliamentarian. Because this is done through special procedures, it all has to be related to the budget. And so the parliamentarian can decide whether this is germane to the budget or if it's outside of that. It can be struck from it. A lot of these pieces have sort of been vetted, so they don't think there's a huge chance, but you never know what surprises sort of lurk. And I would expect in the next day or two for the parliamentarian to sort of rule on sort of, do you need to restructure it? Do you need to tweak it? Or is it fine as it is? That's kind of where we are right now for passage of the law.
Right. Okay, thanks, Christian. So I'm going to dive into two specific energy provisions. The bill has a slew of green energy provisions. I'm just going to touch on two. These are ones that we see in our practice and perhaps you see in your practice. If you're not seeing it in your practice, it might still be something that you need to be aware of because especially with new construction, you may have taxpayers that would benefit from this and they might ask you questions about it and you might also want to mention it to them. So the first one that I'm going to talk about is Section 45L. This is a credit that is available for taxpayers that sell or lease new homes, condominiums, apartments, or manufactured homes if certain energy efficient standards are met. The provision originally expired at the end of 21, and so the legislation proposes to extend it through 2032. Now, I think what's interesting is I'm about to cover some changes to the statute, but those changes don't really kick in until 2023. So for 2022, basically the rule just extends it, so you're still operating under your old rules and old provisions for 2022, but then 2023, you have some new provisions that apply. And so what you're going to see with these new provisions is you kind of have a base credit, and then you have certain bonus amounts. So let's start with the base credit that would start in 2023. So the base credit is $2,500 for a single family home and then $500 for a dwelling unit in a multifamily building. Now, the legislation does modify the standards that apply to obtain the base credit, and so you'll need to look to certain Energy Star requirements. So kind of through secondhand conversations, I've been hearing that some of the current raters that do this work under Section 45L are a little concerned about this change to the standard, because it would be Energy Star doing the certification, essentially, that you meet these requirements. So just something to kind of look out for. Now, the bonus amounts. So if you have a dwelling unit that is certified as a zero energy ready home under the Department of Energy program, then the bonus amount is a $5,000 credit for a single family home, and then $1,000 for a multifamily building. And then there's another bonus that comes in. So if you have a multifamily home and then you're also meeting certain prevailing wage requirements, then you can have a $2,500 credit for the Energy Star requirements, and so that's $2,500 for multifamily homes. So think about an apartment building. That's a lot of units. And then if the dwelling unit in the multifamily home is certified zero energy ready, that's a $5,000 credit. And then when we're looking at this prevailing wage requirement, that's something that is basically determined by the Secretary of Labor to make sure everyone working on a project, your contractors or subcontractors, are all meeting minimum wages within your area. Okay, so let's go to the next slide. Okay, so the next item that we're going to talk about is Section 179 Cap D. Before we talk about the changes, I kind of want to level set and talk about the current law and where we are now before we dive into the changes. So currently, 179D provides a deduction for taxpayers that own or lease commercial building property if they place and service energy efficient commercial building property. So currently, if the property reduces the total energy and power costs by at least 50% when compared to a reference building based on standards set by ASHRAE, the deduction can be as high as $1.80 per square foot, adjusted for inflation, but not in excess of your basis. And then there's this lifetime limit on the deduction for the building. So under current law, once you take that full $1.80 per square foot, you can't take any additional deductions under 179D. Now, the rules also allow for a government to allocate the deduction to a designer, say an architect, an engineer, or a contractor, if that designer is primarily responsible for the design of that energy efficient building property. So that's something that only applied to government-owned buildings, essentially. Okay, so now with the update. So there's a couple cool things with this. One is you no longer have that lifetime cap on the deduction. So we're really just looking at a 3-year period. So you could continually improve your building and still get this 179D deduction. So I think that's kind of an interesting incentive for taxpayers. And then the next thing that I think is really interesting is, remember how only a government building could allocate the deduction to a designer? Well, now tax-exempt entities can allocate deductions to designers under the proposed language. And so I think what's interesting from a tax-exempt taxpayer standpoint is when they're working with, say, their architect, engineer, or contractor, they might want to negotiate lower prices if they can allocate this deduction. So, hey, well, yes, you'll do this work for the X amount, but if you factor in the fact that we will allocate this deduction because you're primarily responsible for the design, then can you give us a discount on these assets that are being installed on our property? A couple other things. The threshold for energy savings is lowered from 50% to 25%. And then as you cross that 25% threshold, you start to see more and more of a deduction per square foot. And again, we have a base, and then we also have a bonus amount. So our base will start at basically 50 cents per square foot, but it can't go up above $1. But then if you meet the bonus requirements, because you meet prevailing wage requirements and certain apprentice requirements, you can get up to as high as $5 per square foot. They've also modified the ASHRAE standard. The current language is not completely clear to me, and it doesn't exactly match up with some of the summaries on section by section summaries. So I think hopefully they'll do a little bit more work on this, and it will be a little bit clearer as to what the standard that they intend for taxpayers to apply will be. There's also an elective alternative deduction. Haven't quite figured out why you would want to do that yet, but I'm sure there might be a situation where that could come into play. So let's go to the next slide, and we have a polling question. And so let's direct this polling question to 45L or Section 179D. Do these hot topics relate to needs or ideas that your clients have? And like I said, you might not work in this space, but if you're working on new builds, new construction, you might have taxpayers that these types of credits could apply to. We'll give everyone just a moment to answer those questions. And hopefully, yes, no, a little bit, and no idea.
I think we're there.
Okay. All right, so 66% said yes, so that's good to know. And some a little bit, 7% of you said no, but hopefully it's something of interest to you, and 2% no idea. But I think you might, now that you've kind of been exposed to it, hopefully you'll start seeing it a little bit more where it could apply. Okay, so let's go to the next slide, and I think, Christian, you're going to talk about the CHIPS legislation.
Yep, can you all see my screen still?
Yeah.
Great. All right, so this isn't, well, as of this morning, Biden hadn't signed it yet. I think he's waiting until he comes out of testing positive for COVID. But it went through the Senate and the House on a bipartisan support. It came out a little bit before the announcement that they had agreement on Build Back Better. And so some of the Republicans were not too happy about the timing of it, and so they whipped against it in the House, but it still got 20 Republican votes. And so what it does is it provides a bunch of money through grants, loan guarantees, other assistance to enhance the research and development and the production of semiconductors and training in the United States. It also includes a 25% tax credit for semiconductor capital expenditures related to machinery that is used in manufacturing in the U.S. So it seems to qualify for 25% for two parts. One is the production facility itself, and then the capital spend for a supplier who has to expand capacity to now supply for the increased demand. So again, we only think there's going to be a handful of facilities built in the U.S. since they're so expensive. We do expect to see this more applicably applied to some of the suppliers who have to sort of gear up to stock these new places. All right.
Okay, so I'm going to dive in a little bit to the Advanced Manufacturing Investment Tax Credit, and I promise this does have a little bit of a cost side component to it. So basically, this is an investment tax credit that's aimed at accelerating the manufacturing of semiconductors in the U.S. There was a section-by-section summary that was done by the Commerce Committee, and I really liked its explanation. Basically, it says, this creates a 25% investment tax credit for investors in semiconductor manufacturing, and that includes incentives for manufacturing of semiconductors, as well as the manufacturing of specialized tooling equipment required in the semiconductor manufacturing process. Also, taxpayers can elect to treat the credit as a payment against tax, like a direct pay. So it's basically, it can be a refundable amount. The credit is provided for property placed in service after December 31st, 2022, and then it ends in 2026. What I found interesting in reading the provisions, and there's a lot that we don't know yet, but what I found interesting is when you're looking at what could qualify for this credit, it does say that certain buildings and structural components, if they're integral to the operation of advanced manufacturing facility, they could qualify for the credit. And generally, it needs to basically be kind of an original use concept. Either it's new to you or you're constructing it. And anyway, the statute specifically carves out any part of the building or portion of the building that's related to offices or administrative services or other functions unrelated to manufacturing. So if you have a building that, let's say 80% of the space relates to manufacturing that would qualify, but 20% say is office, I think that's where we could use our cost segregation techniques to kind of allocate the cost between what qualifies and what doesn't within that building. Okay, so that's all I have on advanced manufacturing investment tax credit. Christian, I'm going to hand it over to you.
Okay, so now we're going to talk a little bit about the DC tax policy landscape. Right now, Congress is very concerned with inflation and supply chain disruption. So part of what the House did last year was, the Build Back Better. It passed in November of 2021. It looked like it died. It came back several times, and then it got rebranded as the Deficit Reduction Act, but a much more slimmed down. So there's still lots of things, things that we talked about that weren't in the bill were, corporate tax increases aside from the minimum tax. The international, I know there's a lot of people concerned with the Pillar 1 and Pillar 2 that's going to be adopted throughout Europe, which is going to cause some pain if we're not on board with it. And then in the back of everyone's mind are the individual tax rates, which are set to go back to pre-TCJA in January of 2025. So those are all things that are sort of, and part of some of the Democrats were trying to push for is an increase on the rich, right? You always hear this sort of messaging where, the rich aren't paying their fair share, they need to pay more. And so that's kind of what sort of the tension is, right? So the Democrats want to sort of increase these rates and the Republicans don't. Then we have sort of the expiring provision, right? We talked about the 174, the 163J, things that seem to have, or at least arguably bipartisan support, are sort of getting pushed further and further. Again, most people are a little bit surprised that the Deficit Reduction Act occurred. And so that's going to probably consume most of the oxygen within the DC tax policy area. And so hopefully that'll be resolved in the next 2 weeks. And then we're going to go into prime campaign season. And so we expect a lot of campaign rhetoric going back and forth. We don't really expect a whole lot to get done during that period of time. Then after the elections have been held, it's called the lame duck, which is, up and through January. I think it's the first Tuesday in January where the new Congress gets sworn in. That's the time where we see sort of lame duck legislation extenders, again, which where we probably will most likely see a correction to 174. But again, it depends upon how the election goes, right? And whether or not there's outgoing members who are willing to vote to fix 174. And by fix, I mean, there's one of two things, right? They can go back to the way it was and say, all right, you can elect to currently expense, or we'll make the effective date not this year, but next year or the year after that, and sort of kicking the can down the road. And I don't know if you guys remember the time where bonus depreciation kept expiring. They just kept kicking the can down the road 1 year. We also expect in the lame duck for them to sort of at least talk about bonus depreciation, because bonus depreciation is starting to get phased out in the following year. Again, depending on how the election goes, it may be that there's some, there may not be agreement, in which case it could push to the new Congress. And if you push some of these extenders into January, it gets a lot messier for book purposes and even for planning purposes. And with that, we'll go to the next slide. So again, we expect budget reconciliation window winds down. If they don't pass the Deficit Reduction Act by September, they sort of lose the ability to do the budget reconciliation. They have to do it again in the following year. And so if it doesn't happen by that period of time, odds are it's probably not going to happen. Again, we have the election coming up. That's stage 2, lots of rhetoric. Then you have the lame duck. We talked about the year-end tax extender package. If the Deficit Reduction Act goes through, a lot of the tax extenders for at least the energy side is picked up in that. So there'll be a lot less that needs to be extended. But 163J, bonus depreciation, 174 are all big ticket items. And then you have, again, it's January 2023 is when you get the new Congress. And we'll talk about that in a moment. So right now, Democrats have a thin majority in the House. By most predictions, the Republicans should win back the House. Historically speaking, the party in power has never done well in a midterm. And so it would not be surprising for the Republicans to pick up enough seats to control the House. The Senate's a little more delicate. It usually, I wouldn't expect the Democrats to pick seats up, but it is not impossible for them to hold, but probably a slight edge to Republicans of taking the Senate too. So what happens if the Republicans have the House and the Senate starting in 2023 and Biden's in the presidency? I'm not sure a lot's going to get done tax-wise, except for maybe some extenders. I think a lot of it's going to be the House, which generates the tax bills, is going to submit a lot of stuff for votes on, hey, look, individual rates are about to have an increase. Let's see if we can protect it. And the whole thing is going to be set up for the presidential election and then once the president's decided, right, they'll have 1 year to fix sort of the individual tax rates from expiring and going up. So I would expect if the Republicans take the House, even if they don't take the Senate, that a lot of bills aimed at setting up for the presidential contest is what they're going to focus on. Even if the Republicans control the Senate with the 60-vote threshold, probably not a lot's going to happen. Even if they use the budget reconciliation so they can avoid the filibuster, you still got to have Biden sign it. And so I see a lot of locking heads over the next couple of years, which sometimes is good and sometimes is not. All right, next slide. What are the tax extenders, right? Some of them are the energy credits that have been expiring, but if the Deficit Reduction Act goes through, a lot of these are taken care of. Then you also have some of the stuff that is set to change under the Tax Cuts and Jobs Act, like the R&D amortization, the interest expense, bonus depreciation, and a bunch of other temporary provisions. Also, with the act that the Democrats passed when they first took power in, I think it was 2019, some of those are set to expire too. The child credit's going to expire. And so the Democrats would be interested in extending that. Again, it sets up that tension where the Democrats are saying, hey, we'll give you 174, but give us earned income credits. They need to have something to take to their constituents to show that they're sort of looking out for them. So I would expect to see sort of that maneuvering. Most people think it should happen in December, but it would entirely surprise me if it got pushed off until January. Again, it's never good to bet on Congress. So with that, we'll go to polling question number 3.
Okay, thanks, Christian. So this is your 3rd out of 4 polling questions. How confident do you feel discussing these topics with your clients? Very confident, somewhat confident, not very confident, not at all confident. And we'll give you just a little bit of time to answer that polling question. And Ed, let us know when we've got most of the participants.
Yeah, right. A little over 90% or 90%. I think that's good.
All right. Okay. I think we're ready to move on then. Okay. 56% somewhat confident. Great. That is good news. Okay. Not very confident at all, that's okay. Hopefully this is just the starting point, and you can keep reading all the articles and watching the news and get caught up on what's going on. We've got a little bit, hopefully, we'll see if something passes. Hopefully you have a little bit of time. Okay, so I'm going to talk about the Green Book, and let's go to the next slide. So the Green Book came out in March of this year, and this is basically the Biden administration's budget proposal for the next fiscal year. The tax portion is called the Green Book. The next fiscal year is for 2023, and it begins on October 1st of 2022. There's not a lot in terms of depreciation in the Green Book, but there's 1 or 2 topics that we will touch on. But let's go to the high-level slide next. What I think is interesting is the Green Book is kind of the administration's starting point, right? So this is kind of their wish list, right? And then they have to go into negotiations to actually get the Inflation Reduction Act. So you can kind of see the difference between some of the things that are proposed here and what actually made it into the act. So it's kind of an interesting comparison. So first thing that was in the Green Book was this increase in the corporate tax rate of 28%. As we discussed earlier, that was not included. The next thing is tax incentives for relocating jobs and business activities to the U.S. We do see a little bit of that with the CHIPS Act. The next item is increase the top marginal rate to 39.6%. Again, that is not in the Inflation Reduction Act. The next item is tax carried interest as ordinary income. We've got a little bit of a flavor of that in the act, but we'll see if it actually survives. Limits on Section 1031, we didn't see that at all in the Inflation Reduction Act. And then the last item is 100% recapture of real property appreciation. We did not see that at all in the act. So let's go to the next slide. Okay, so this just basically tells us that, the current law is 21% for C Corp, and then the proposal was 28%. Again, that did not make it into the Inflation Reduction Act. So let's move to the next slide. Okay, the one thing that I do want to focus on, and we are running out of a little bit of time, relates to the proposal related to 100% recapture as ordinary income on certain depreciation of real property. So under current law, basically you're not really going to see a lot of recapture on real property, because when you look at Section 1250 real property, you're only recapturing any amount of cumulative depreciation in excess of straight line. So for the most part, at this point in time, there's not going to be a difference unless you have, say, QIP that you took bonus on, right? So typically you don't have 1250 recapture. Now, for non-corporate taxpayers, there is a little bit of a provision here that says basically, to the extent that those taxpayers have net 1231 gain, any unrecaptured 1250 gain is taxed at 25%. So they get to deduct the items at ordinary income rates, but then if to the extent they have net 1231 gain, they get taxed at 25%. So our proposal basically says that any gain will actually get taxed as ordinary income rate to the extent you had 1250 depreciation before. There are provisions that, of course, would, in line with the administration's goals, is that they would have special rules for those with AGI below 400,000, so that the old rules would just apply. But that does make some very complicated reporting requirements for partnerships and S corps, because you have to calculate under the old rules, the new rules. And I should also mention that the proposal basically would only treat ordinary income amounts for depreciation going forward. And there's a little bit of some issues with the logistics of that, because what if you don't have gain to the full extent of your depreciation? What if it's only of a portion? Is that under the old rules or new rules? We don't really know. But let's go to the next slide. So basically, the reason for this proposal is basically, and I think I mentioned this a few minutes ago, where you have a non-corporate taxpayer, they're able to take an ordinary deduction for this depreciation. But the actual decline of the real property isn't happening as fast as their depreciation. So if they sell the property to gain, then they're actually paying that 25% favorable rate. So you get the offset at ordinary rates, and you're only paying a gain at a favorable rate. So the administration is viewing this as kind of a de facto tax subsidy for non-corporate real estate businesses. And so that's kind of the origin of why they had this recapture. And it's a lot like 1245 recapture, right? It's just going to be treated as ordinary income, but it is a little bit more complicated because they're trying to make sure that taxpayers with AGIs of like 400,000 aren't going to get swept up in this. Okay, so let's go to the next slide. Okay, so one of the other proposals that was in the Green Book that, again, we did not see in the Inflation Reduction Act relates to like-kind exchanges. So basically, in the Green Book proposal, taxpayers could only defer $500,000 a gain in a like-kind exchange, and then $1 million if you had a couple that was married filing jointly. And then any amounts over that $500,000 would be taxed just in the ordinary manner that of a real property sale. So that's a really substantial limit to like-kind exchanges. Again, we didn't really see it in the Inflation Reduction Act, so the proposal had a certain date. So it might have been, if this actually had come to fruition, we might have been concerned about like-kind exchanges in progress. But I'm not sure if right now that's really a concern at this point. So let's go to the next slide. Okay, so just really quickly, I'm going to talk about exam activity, and Christian, feel free to chime in whenever, if you have any additional comments. So I can say that what we've been seeing in RSM, we've had specifically industry related. We've had a couple taxpayers in like the cold storage and cold packing industries have exam activity related to cost seg and repair studies. I have heard people, I was at a TEI recently, and someone on the panel from another firm mentioned that they already were having QIP issues examined. And then we've also seen a little bit of examination in the 179 Cap D area. It is an LB&I campaign, so it is something that we know that they're looking at. And then Christian, did you want to add anything to that?
Yeah, I mean, we're seeing a lot of exam activity, and they're being very aggressive on R&D under Section 41. And they're also, I think, that the 179D is getting dragged into that because they're viewed sort of similarly, and it's mostly the whether or not you're a designer, I think, is the big controversy. And so the service is not, a lot of times you sort of go into exam with an IRS agent, they're somewhat reasonable, and you're trying to get to the right answer. Kind of the 179D and by extension Section 41, they're being pretty aggressive in denying it. We're getting we're seeing things like appeals offering 25 cents on the dollar, whether it's, whether there's risk or whether it's not, it's just everything. It's like, nope, we'll just give you 25 cents on the dollar. And so it sets up an interesting dynamics, right? Because with all the sort of focus on Section 174 and allowing people to currently expense, it's weird to say we value innovation. Congress says we value innovation. In fact, there have been proposals to double the R&D credit, but at the same time, the IRS is taking most of it away on exam. So that's just what I'm seeing in relation to those two.
Yeah, and I will say, because we have seen some increased activity in 179D, when we get studies that other firms have prepared, we're taking a closer look at those to really make sure that if it's going into our client's return, that it is meeting requirements and that we have everything documented correctly, and we're really drilling down on those items to protect the client and to protect our firm that's signing the return as well. Okay, so I think we can go to the next slide, unless Christian, you want to add anything to that?
No, but what I'm going to do is jump to the last polling question and then go back to the PTP plan, if that's all right with everybody, just to make sure that everyone gets their CPE in. Uh-oh. There it goes. How confident do you feel Congress will pass the Inflation Reduction Act of 2022? A, very confident. B, somewhat confident. C, not very confident. D, not at all confident. And so I got 72%, 78%. Remember, this is the last one, so if you missed one, you definitely need this one. If you got the other three, then this is the bonus one. And it looks like 55% are somewhat confident. Wow, 7% are very confident. I wish I had that sort of level. 26 not very confident, and 12 not at all confident. So a decent bell curve. I think most of the handicappers think it's anywhere from 50-50 to more likely than not that it will get passed. We have Dave Carter, who used to be the tax policy over at Treasury under the Tax Cuts and Job Act. He always thought something would happen up until like a couple of weeks ago for the Build Back Better, because Letting the Reconciliation Act expire and not be used is tantamount to political malpractice. So with that, let us go back and talk about and close the polls and go to the PGP.
So I have learned to never be very confident, but I'm probably more at B on this one. But let's talk about the PGP. So there are a couple of things on the priority guidance plan. One relates to regulations under Section 179 Cap B to clarify the definition of a designer and to address other issues. So I'm excited to see those, at least a draft of those, because we do have notices, but they're pretty old. Then it's been on the plan forever. I think it's gone off and it's come on, but guidance under Section 280F clarifying the business use of an aircraft by parties related to the lessee. That is on the PGP. And then finally, a RevProc concerning the capitalization of natural gas and distribution property. And I'm trying to remember from the last American Bar Association, I thought they were actively working on this. I'm not sure if it was a RevProc or not, but it did sound like they were working on this. So I think that's all I've got for priority guidance plan. But I honestly, if the Inflation Reduction Act passes, I think we're going to have a lot more stuff to look at and talk about beyond just this priority guidance plan list.
So I guess, does anyone have any questions? That would be the time. Otherwise,
Yeah, we had a couple of questions come in. Are you hearing anything from Washington regarding extending 100% bonus past 2022?
Yes, but not a lot. I think this is one of those that in the past, right? It's always sort of gotten up to where it expires and then it gets sort of back on. Like everyone wants to encourage production, especially with supply chain issues going along. I think it will be talked about a little bit, or it'll pick up again when they start talking about the extenders. There's just been a lot on everyone's plate this year, and so it's always sort of been, well, it hasn't happened yet, so Congress loves to sort of put things off to the last possible moment. But I would expect some to address it in the extenders.
A couple other questions. One is not to get political, but what does this act do to reduce inflation?
It reduces the deficit theoretically, which reduces, some of the cash out on the market, which should lower the price of stuff or at least decrease some of the inflation. And it's supposed to lower drug prices for a good chunk of the populace, which should help them with inflation too. So it's not necessarily monetary policy. It's more sort of all right, let's see if we can at least reduce the cost of some of the stuff going up.
Okay, one last question. For 45L and the prevailing wage requirement, would that mean that all construction would need to be prevailing wage?
Yes, so the Department of Labor sets the prevailing wage, and I think everyone from the contractors to the subcontractors involved in a project would need to meet the prevailing wage requirement.
Okay, any other questions? We have like 1.5 minutes left or something. Well, not seeing any questions come in, then we'd like to thank our presenters, Christian and Tracey, for being with us again today. Another great session. And you folks, if you have a question, we can get you their contact information. Maybe you can throw them an email or what you might like to do. Otherwise, we'll close it out now and see you all next time.
Thank you.
Thank you.